All right, can you all hear me? Again, my name is Zach. I'm with Texas Class. I have been working with public funds here in the great state of Texas for the last 20 years on investments. Most recently, I've left the bond brokerage business doing longer term investments with public funds to joining Texas Class, which is a local government investment pool, which many of y'all might use. And it's a money market fund strictly for public entities. So certainly appreciate being here with you today. I'm not an economist, but I'm going to try to play one today, and we're going to talk about the economy and some things that are happening right now, from what the pandemic created to what we're seeing right now in the economy. I will not keep you too long from lunch, but hopefully we can have a nice conversation and get you some good information. So today, we're going to talk about what the Fed has done. Have they done enough? The Fed appears to be nearing its ending of the rate hike cycle. Are we there yet? I don't know. We'll talk about that in a second. Most of the Treasury yields have fallen below the Fed funds rate right now. So overnight rates are the highest they've been in a very long time, but also higher than longer term investments. So it's a unique position that the economic cycle is in, especially when you're talking about yields. And then with the recent bank failures that we've seen, we were just talking about real estate. So with bank failures, we're going to see tighter credit standards. So it's going to be harder for folks to get loans, which also is going to have an impact on the housing market, which overall will impact the entire economy. So moving forward, let's talk about GDP. What is the real domestic gross product? Well, if you think about GDP, GDP is kind of like a health checkup, going to the doctor and getting a physical, except for they do it quarterly. So you'd be probably a hypochondriac if you were doing a physical that often. But what we're seeing here is that in the second quarter of 2020, we had a huge hit to the GDP. That was the pandemic. Then what you see is a spike back up. So you got the stimulus money coming back into the economy and kind of levels out through the next couple of years. And that's really the stimulus money kind of evening out the economy. What's kind of noticeable, though, you can see the trend happening is that we're starting to move down right now, which is one of the signals that we're seeing that we could be headed into, if not already into, a recession. GDP is made up of four main components. You've got personal consumption, business investment, government spending, and then net exports. So prior or pre-pandemic, 70% of the US GDP was personal consumption. So it's a huge portion of what the GDP is made up of. So if we are to start to see consumer spending level off, we're going to see a real issue with GDP. So as we continue to look forward, and we see that stimulus money kind of leave the economy, prices increase, which basically equals less purchasing power for you and I. And that's really caused by inflation. So that, again, that's going to be a negative impact on the US GDP. I don't know if that goes all the way down. Okay, so basically, again, to the prior slide, this is GDP, again, showing a forecasted GDP. Right now, we've seen basically from the pandemic, we got the stimulus money, but now that that's been spent, you're starting to see GDP decline. What's interesting to note is that right now in the first quarter of 2023, the US GDP was 1.1%. The 10-year average is 2.2% GDP. So we're basically half of what our normal average is. That's important because economists, government officials, businesses, and the like use GDP as the barometer for the health of the economy. So it being at half of what the 10-year moving average would be, is a significant impact or indicator that the health of the economy is pretty bad, and moving that way. They expect the long-term trend to move up to 2%, but we'll have to see kind of what other factors play into the economy as we move forward the next year and a half or so. Here is the Federal Reserve balance. I wonder if I can move this so it's, here we go. So the Federal Reserve balance sheet, it's important to look at this because you can see as the trend line goes up, we basically had roughly $4 trillion in the federal balance sheet. Pre-pandemic, you saw interest rates basically decline to almost zero once the pandemic hit, and then the Fed's balance sheet ballooned. The wallet opened and they started purchasing. It went from $4 trillion to $9 trillion, where we currently sit. So huge uptick in the Fed's balance sheet. And that really has to do with the stimulus money coming out. So we've expanded the Fed balance sheet significantly, which really has created the inflationary situation that we're in. You can't print trillions of dollars and not expect to have inflation happen. So that's really kind of what's happened in the economy from the pandemic to right now. So you got massive amounts in our Fed balance sheet. If you notice at the end of the graph right there, you see a little uptick in the Fed balance sheet. That's not stimulus money. So if we just want to touch real quick on the recent bank failures. So what that little uptick is on the end of the graph basically is the Fed buying back assets from those failed banks off their balance sheets at par. So what happened to, just briefly to describe the failed bank scenario. So you had these banks that were buying government treasuries and agencies, and as the Fed continued to increase the rates at these rapid rates, the value of those bonds that they were buying, so you bought it at January and they raised rates again in maybe March and then did it again. Well, those bonds that they bought in January now were underwater. So they may have bought it at 100, but now it's worth 90. So basically their balance sheet was getting hit. And that's what ended up causing the run on the banks. And once all the money started falling out, they couldn't sell the assets at the same price. So basically the Federal Reserve stepped in, bought those bonds back at par, on those Treasury and U.S. agency bonds back at par. And so that's where you see that uptick to basically keep those banks solvent. So that's what kept the whole banking system from having a massive run on it. It was the Federal Reserve stepping in. So everybody wants to know, where are we headed? Where are rates going? What's the probability of us having a rate hike, a rate drop? Is the Fed planning to continue where they're the pace that they're on? Right now, I can tell you that the market probability, so is 0.74. Those top numbers is what the market probability is of a rate hike. So right now, the market is, and the Fed is signaling that we're going to see another 0.25% raise in May, or in just a few weeks. So in May, we're right on the cusp of that. Will we continue to go up one more? That's to be seen. Odds are that we probably will end up going another 25 basis points after that. So a total of 50 basis points, but certainly 25 basis points is baked in to the market for that interest rate rise in May. But as you can see, this line is declining. If you would have looked at this a year ago, we would have seen an upward slope instead of a downward slope. So the market is signaling that we are going to see some cuts later on. However, I don't think the market is right that we're going to see it this year. One of the things that I would point out is that if the Fed right now is signaling that they're going to raise rates again 0.25%, why would they go ahead and do that if they were just going to cut rates, 3 or 4, 6 months from now? It just doesn't make sense. So odds are is that they're going to raise rates again and then go into a holding pattern, possibly another 25 basis points, but that may put way too much pressure on the economy and really send us into a bad recession. So what the Fed's trying to do, they know we're already on the cusp, if not already in a recession, but they're trying to keep us from spiraling out of control. However, by mandate, they're trying to keep the employment rate and inflation in check. And so they only have really one tool, and that's the federal funds rate. So again, expect that we'll see a little uptick, and we'll talk a couple of graphs. We'll see a little bit better signal on that, but an uptick in the near future, and then a pause, and then probably mid-24 start to see some rates decline. Again, there's lots of variables at play, but that's what the market and most economists are thinking right now. So this is personal consumption and inflation in general. The consumer price index eased to 5% in March of 23, down from 6% in February. We hit a high of 9%. So we are moving in the right trend. The Fed is making progress in that way. What's interesting to note, though, I think some inflationary statistics right now are pretty interesting. So if you look at the price of eggs, how much they've increased, 36%, margarine, 33%, frozen vegetables, 20%, airfare has gone up 17.7%, motor vehicle repair, 17.4%, bread, 16.5%, food vending machines, 16.2%, motor vehicle insurance, and insurance across the board. But motor vehicles gone up 15%. I'm sure if you've had to go renew your insurance, you've seen that in your bill. Electricity has gone up 10%, and then chicken's gone up 8.9%. So really across the board, things have gone up quite a bit, which we all know we're talking about. We all feel it in our pocketbook. The goal for the Fed is to keep 2% inflation, which is still quite a bit away since we're hovering in the 5 to 6% range right now. But some are concerned that the Fed didn't do enough early enough, or it's done too much. And so the Fed normally has a tendency to go too far, too fast on either direction. So that's something to keep in mind right now. And of course, they're trying to keep the employment numbers in check too. Basically, the important thing to see on this one, I really want to point out, obviously there's a lot of things that are contributing to inflation, but the main one that is really the sticking point is rent and shelter. And so that's that green line that's kind of shooting up. And as we were just listening to the last presenter about how home values have gone up, although they're starting to slide down now, rent is still very high. So it's still very expensive for folks to rent an apartment. It's hard for folks to buy a house right now because home values have increased so much. Even though they are going down, they're still a lot higher than they were 2 years ago. And so then that makes it difficult for folks to find it or buy a new house. And then, as I just mentioned, it's going to be a lot harder for those folks to get a loan based on the new tighter lending standards. So it's a really double-edged whammy for folks who, if you wanted to buy a house that was worth $150,000 3 years ago, now that same house is worth $250,000 or even more, and then you can't get a loan now because of the tighter lending standards. So it's a real conundrum for folks. So that's really the main point I want to show out. Even though we'll see some other prices and other sectors start to come down, it's really going to be interesting to see what happens in the home values and rent and shelter sections of inflation. job wage growth. This is kind of an interesting. I got some statistics. Whew, that was a tough one to talk about wages. So, despite the level of wage growth growing 6.7% in the summer of 2022, it has not been enough to curb inflation. So the federally mandated minimum wage in the United States has not increased since 2009. So that means individuals working in minimum wage jobs have taken real-term pay cuts for the last 12 years. What's interesting to note, not every state has the same minimum wage laws, so they vary state to state. So for example, in California, the minimum wage is $15.50 an hour, but in Oklahoma, it's as low as $2 an hour. So it's not all across the board. And of course, $2 has to do with some service industry jobs where they can earn tips and the like, but still, it's not across the board and equal state to state. In 2021, the minimum wage in the United States would have been $22.88 an hour if it had grown with productivity in the United States. However, the current minimum wage is $7.25 an hour and has remained unchanged since 2009. So if you think about that, basically, most people are earning the same amount of money, but things have increased so much more that it hasn't kept pace with inflation. So it's very difficult for us to keep pace. If you're having to pay 33% more in eggs, but you're still earning the same amount of money. So it's really hard for folks out there to continue the same lifestyle that they've been on based on where the economy is right now. Wages and prices have risen the fastest pace in decades, but just haven't been evenly matched. So that's really what I wanted to point out there. The Institute for Supply Chain Management, basically there's just two different indexes, one for manufacturing, one for services. There's lots of key components to it, but bottom line is, if anything above 50 is expanding, anything below 50 is contracting. You can see right now, here was pandemic, but this is where we're headed. And so we're headed into a contracting period, which really is signaling, again, recession. Unemployment, there's two. You can have multiple unemployment rates. Important to note, during the pandemic, we basically lost about 9 million jobs. A lot of that labor force has come back into the market. What's been kind of interesting is that you had a lot of folks leave the market who were of retirement age or close to it, went ahead and left the labor force, didn't want to come back. Safety concerns, health concerns, didn't want to go back. But what happened is the Fed cut rates to 0. And so if you were on a fixed income and you were hoping to earn 4 or 5% on your retirement, and now you're earning basically 0, it forced you to go back to work, or has forced you to go back into the labor market. So we've got these baby boomers that had planned to retire, but are still back into the labor force. We have seen the labor force come back some, but there's still a lot of vacancies out there unfilled, that with a weakening economy, having listened to several other presentations here recently that have talked to executives, when they ask them, are you going to take some of these job postings down? And they say, no, we're not going to take them down. But you ask them if they're going to fill them. Well, no, we're not planning to fill them, but we don't want to take it down just in case someone does apply and it's the perfect fit, then we'll leave it there. So there's a lot of job postings out there that have no intention to get filled because of future economic weakness. So that's something just to kind of keep in your head, that you see like, oh, I see all these job postings. There's tons of jobs out there. But yeah, but they're not planning to fill those. So it could kind of be a false signal to you. Um, talk about the openings. So again, you can see right there, lots of job openings. You've got lots of people looking for work, but who knows if those will actually get filled or not. Non-farm payrolls, basically another barometer of the health of the economy. What a higher payroll figure is generally good for the U.S. economy, citing more job additions and a more robust economic growth. As you see here, from January to March, we are trending down again. So, you know, hate to be the bearer of bad news, but a lot of these downward trends are not super positive for the strength of the economy right now. So previously, the previous presenter was talking about home pricing. I did touch on it. Basically, the Case-Shiller index is a index used to track single-family homes. Right now, you can see where we had seen a huge spike in prices from the pandemic until now. Obviously, we're seeing that drop off, and that's an issue. It'd be great for things to level out in the housing market, but again, that tighter credit is going to be tough, even if we see rates or prices come down significantly. I touched on yields before, but here's basically the U.S. Treasury yield curve. It's inverted, which is not normal. It should be lower rates on the short end and then move higher. So basically, an inverted yield curve, typically is not a good thing. Also, those two, the dark green line on top is what was expected January 1 of 23. The bottom blue line is what is the market's expecting right now in the curve. So you can see that they do expect rates to decrease here at a more rapid rate than we did even back in January. The same thing here with the T-bill curve. I mentioned that the Fed is expected to raise rates. This is giving you another data point that is expected. One of the, if you were to have both charts up together, the point I want to make is that the 3-month Treasury is at a 486. The 10-year Treasury is at a 364. So when you see the spreads between the 3-month and the 10-year Treasury negative, almost 1.2%, when that has happened in the past, a recession has always followed. So every time we've seen that in the past, that inversion, a recession has followed. So I'm not saying that we are going to be in a recession if we're not already in one, but I'm saying that all the signals are pointing that way. Money market curve, I do want to mention for those who are in money market pools that have commercial paper, which a lot of folks are, it's a great time to be in those money market pools. Right now, currently, I know we're paying 507 overnight, so it's a great time to be liquid and earning those great rates. Commercial paper pools, this money market curve is showing you that by having commercial paper in those money market funds, you're basically earning about 88 basis points more over the long run. And so having that credit in is something to be cognizant of, and certainly a good place to have your money. Federal Reserve dot plot. This is just another tool for folks to basically see what the Fed is projecting. This first line is showing that most of the Federal Reserve members expect us to increase by another 0.25%, which is those line, all the dots right together right here in this first line. So the Fed is signaling they will be raising rates another 25 basis points. Overall, they expect Fed funds by year end to be around 5.10. There are a few that expect it to be a little higher than that, but on average, we expect to be around the 5%, 5.25 range by year end. Let's talk real quick about the local economy. As far as Texas goes, Texas has been healthier than most other states. We've got a robust economy. The Texas economy, interesting fact, is 2.5% of the entire global economy. So Texas is a huge contributor to the global economy. There's 1,000 people a day, 365 days a year moving to Texas. It is an astounding number. Texas is growing at a wild pace. Most of the folks moving to Texas are moving into the more populated areas. So the DFW, Houston, Austin, San Antonio areas. They are moving down south as well, but I would say the majority of folks are moving into our big metroplexes in Texas, which is a strain on a lot of the infrastructure. I don't know if any of you have been to Austin or San Antonio lately, but you can see the construction and traffic, especially in Austin. Austin is one of the worst places of traffic in the United States. And if you've driven on 35, you will absolutely believe that. Texas job growth holds strong. You know that we're at 5.1 as a state. The national average is 3.2. So, and then several other local economies, including some down here in South Texas, are growing at an even greater pace. So Texas overall is in a really great spot. God bless Texas, right? I'm not going to harp on this too much. We've just heard about the median home price declining. I want to point out too, though, in February, the average 30-year home fixed rate mortgage price rate was 6.7 in February. That has increased from then till now. I just heard somebody get an 8% 30-year fixed rate. So that's kind of crazy. We haven't seen those numbers in a long time. You know, I thought 5% was high when I bought my house. So it's certainly moving up, and then it just refinanced down from there. So anyway, something to be to be noteful on. Let's get down to South Texas, which y'all are probably the most caring about. So we talked about how big the Texas economy was globally. Let's just talk about South Texas. South Texas is a huge portion of our Texas economy. The domestic GDP of South Texas in 2020 was 84.8 billion. So that's awesome. That's about 5% of the 1.8 trillion Texas GDP. So lots of good things happening down here. Out of all the counties in South Texas, Hidalgo County is the fastest growing between 2010 and 2020 at a rate of 12.4%, and is also one of the fastest growing counties in the state. Texas had an overall population growth of 15.9 during that period. South Texas as a whole grew 6%, which was a little bit below the U.S. growth of 7.4%. Interesting fact is that nearly 30% of the total population in South Texas is under the age of 18, and which is higher than most other regions within the state. As of 2020, 800,000 people were employed in South Texas, which was a growth of 7.2%. The overall growth in Texas as a whole was 17.1, so it was lower than that, but close to the U.S. employment growth of 7.8. So about average for the entire country. The home healthcare services is one of the top industries for employment in South Texas. which I think is a great thing. There's lots of snowbirds down here too. As far as the total employment for the U.S. and then broken down to the region, you can see the major cities. You've seen some nice growth compared to some other areas like Corpus Christi, Harlingen, Brownsville, great growth. McAllen, Edinburgh, 13.9, so way above the national average there. Unemployment rate, 6.8%, still healthy economy. Then we'll talk about two of the major cities in South Texas. McAllen is number 5 top 10 places for middle income Americans to purchase a home. So great bang for your buck as far as cities across the U.S. to live in. Housing costs here are 55% lower than the national average. Healthcare expenses are 23% less expensive than the national average. Grocery items are 17% less than the national average. And while utilities do cost more, we think that possibly the higher temperatures in South Texas might play a little effect in that. Moving on over to Harlingen. Harlingen is one of the least expensive places to live in the U.S. Amongst metros with at least 50,000 or more inhabitants. Unemployment rate is 5.7%. Pretty much everything in Harlingen costs less than most everywhere else in the U.S. And although agriculture remains a very heavy focus in Harlingen's economy, healthcare, telecommunications are rapidly gaining importance. You've got some really big players that have moved down into South Texas. You've got Frito-Lay, you've got H-E-B, Durabag Manufacturing, T-Mobile has a big presence down here. And then you've got SpaceX. So you're even in the space game, which is really interesting. So lots of good things happening down here. Even though we've got a global economy that's struggling, we got a U.S. economy that's struggling. Texas as a whole is doing really well, and South Texas is a vital part of that. You've got lots of different, sectors that are providing lots of jobs for y'all. Transportation is huge. Obviously, the border with warehousing and the cross-border intermodal transportation is huge. A huge hub for getting goods to the rest of our country, all come out of South Texas. And then technology is really becoming a big focus for South Texas, along with, basically a great network of universities and schools to educate the young workforce. So lots of residents under 25 that are going to be looking for jobs. And so that's why a lot of industry is coming to South Texas, because you have that working capital and that workforce. So with that, I will kind of wrap things up and leave it up for any questions that y'all might have.